From bad to worse, next year's economic risks are already here. Cheap money, a thriving China, and decades of great power peace have all vanished. Next year could be the year when their absence really hurts. The global economy has had a terrible year, however things can always get worse. According to history, the Federal Reserve's rapid interest rate hikes may force the United States into a recession in 2023. You will be surprised if your spiraling natural gas prices do the same. The combination of COVID-0 and the property slump presents to bring China's economy to a halt. In the worst-case scenario, all of these things occur simultaneously. According to Bloomberg Economics, this could wipe out $5 trillion in global output compared to more optimistic forecasts at the start of the year. The fact that such a bleak forecast is far from implausible suggests that something major has gone wrong with the global economy in 2022. There has been plenty of evidence of this: cheap money, supercharged Chinese demand, and low-friction geopolitics, the secret sauce that delivered decades of mostly steady growth and stable prices have all vanished, leaving inflation and multi-decade highs and financial market losses in the trillions. There are some bright spots that could put a stop to the rot next year. With the labor market proven resilient, the Fed may pull off the fabled soft landing. Warm weather may save Europe from a recession. China may choose to end lockdown sooner rather than later. Some of these possibilities became apparent last week when markets rallied in response to lower than expected U.S. inflation and signs of a Chinese shift away from COVID-0, even if those prove to be false dollars. Investors who see a peak in interest rates in the bottom and growth may begin to bet on the coming recovery. Still, it's difficult to be optimistic after years of plague war and scarcity. Here's a look at the top economic risks for the coming year. The great rate squeeze is underway. The Federal Reserve's benchmark interest rate is expected to reach 5 in early 2023, up from 0 at the beginning of the year. The most aggressive monetary tightening in decades is already harming the American and global economies. There's more pain to come. Bloomberg Economics predicts the U.S. recession in the second half of 2023 as higher borrowing costs hit rate-sensitive industries ranging from real estate to autos. Over 2 million Americans will most likely lose their jobs. Things could get better if inflation vanishes as quickly or mysteriously as it arrived. However, they are more likely to fail. The pandemic has thrown labor markets out of whack, pushing the natural rate of unemployment, the level of unemployment required to keep inflation under control, above where it has been in recent years. If that occurs in the United States, which Chair Jerome Powell believes is a possibility, the Fed may be forced to raise rates as high as 6% tip in the world's largest economy until a longer and deeper recession, because most countries share America's inflation problem and their central banks are following the same path to solve it. The risk is replicated globally, and economies that want to deviate from the trend don't have a free pass. Japan has maintained negative interest rates, but at a high cost in currency markets, with the yen losing more than 15% of his dollar value. Debt risks have resurfaced. Public debt was inexpensive as long as growth rates exceeded borrowing costs. Governments piling on the total owed by the Group of 7 developed economies increased this year to 128% of GDP from 81% in 2007. Now, as economies slow and interest rates rise, the calculus has shifted, and the bill is due unless painful fiscal adjustments are made. Several major economies may find themselves on an unsustainable debt trajectory. Investors are keeping a close eye on the lead, where debt service costs are expected to rise to 7% of GDP by 2030, up from 3% in 2019. Italy is unlikely to default, however. Avoiding that outcome may necessitate a European-level fix, which is typically a difficult process. Its Prime Minister Liz Truss failed fiscal splurge brought UK bond markets back from the brink. However, closing the fiscal gap and maintaining credibility with investors will necessitate a period of painful budget austerity. The United States isn't quite in the same league. Nonetheless, the looming debt ceiling debate, heightened by the Republicans' midterm victories, will keep markets focused. Haruhiko Coronado, the architect of Japan's low-interest rate strategy, will leave office in April. His successor is faced with a difficult decision: continue to use cheap money, risking for the currency collapse, or follow the Fed and destabilize one of the world's largest debt piles. The problem is more acute in some emerging markets. Sri Lanka, like Lebanon and Zambia, has a history of non-payment. For the time being, the problem appears to be under control, to fault in emerging markets, a trigger a wave according to Bloomberg Economics model, and default risks are much lower today than they were in the 1980s and 1990s according to Bloomberg Economics model. And many default risks are concentrated in small economies, accounting for only 3% of global GDP, with larger developing countries likely to avoid a debt crisis. Turkey could be an outlier. An election in June will almost certainly tempt President Recep Erdogan to pursue even more unconventional policies to boost growth at the expense of the lira and possibly debt. Sustainability housing appears to be vulnerable. Type money means as crunch time for global housing markets. Countries such as Canada and New Zealand, which has some of the frothiest housing markets in the world based on metrics such as price-to-income ratio, may find themselves on the front lines. The United States isn't at the top of the risk rankings, but it's not far behind. Bloomberg Economics estimates that a 15% drop in national prices will be required to bring mortgage payments in line with household incomes. Everyone's problem are China's problems. The base case for China is that reopening the economy after COVID-19, a process that has already begun and will likely gain traction following the National People's Congress in March, will offset the continued drag from real estate, resulting in slightly stronger growth. Bloomberg Economics predicts 5.7% growth in 2023. The risks are heavily skewed to the downside. It is unclear when and how the government will end COVID-19, according to Bloomberg Economics. Property construction must drop by 25% to keep up with shrinking supply. Furthermore, the impending retirement of top economic officials may leave President Xi Jinping with a team devoid of crisis response experience. Failure on both of these fronts could reduce Chinese growth to 2.2%. If the property crash leads to a financial crisis, even that figure will be out of reach. A sharp slowdown would send shock waves around the world. The greatest impact will be felt by China's Asian neighbors, ranging from Korea to Vietnam, as well as major commodity producers such as Australia and Brazil. Europe's energy tie and the world's polarization into rival camps, which is already imposing steep costs on Europe, is the final piece of the global risk puzzle. Support for Ukraine following the Russian invasion has resulted in natural gas shortages and skyrocketing power prices across the continent, according to Bloomberg Economics. High energy prices and rate hikes by the European Central Bank will push the EU into recession, with GDP shrinking 0.1% in 2023. Europe could avoid a downturn with some luck. The weather and skill policies that channel scarce gas to the right places without either the economy risk centering and contraction similar to that seen during the global financial crisis. Crude has fallen from a water ribbon high of nearly $130 a barrel in the first half of this year. A combination of new sanctions against Russia, reviving Chinese demand, and OPEC supply cuts could push it back up next year, opening another front in the energy crisis in Europe and beyond, and fueling the inflation fire. Global alliances are spraying the energy crisis in Europe caused by the standoff with Russia is just one example of geopolitical fracture. Relations between the United States and China are also deteriorating. President Joe Biden has maintained the tariffs imposed by his predecessor Donald Trump, and then a step further by imposing the ban on the sale of cutting-edge semiconductors, a move that threatens to turn China into a kind of Amish community with technological development stalled. Trade tensions are a slow burn drag on growth in both countries, with China bearing the brunt of the burden. Taiwan is a flashpoint where a slow burning fire could ignite the delicate balance that has kept the Strait peaceful. Appears to be breaking down, as does trust between Washington and Beijing, owing largely to China's growing political and economic clout. The consequences of a blunder could be severe. Say, the United States overplays his hand by recognizing Taiwanese independence. China responds by blocking it in the island. The United States and its allies impose a barrage of sanctions even if conflict is avoided. Taiwan's central role in semiconductor production and China's central role in everything production could result in a supply chain snarl par with the worst of the Coven era. Fortunately, military conflict is still unlikely for some countries. The growing schism between China and the United States represents a golden opportunity. Apple's decision to begin manufacturing of the iPhone 14 in India is one indication that corporate titans are hedging their exposure to geopolitical risk. Vietnam and Mexico, for example, stand to benefit. Other things could also go wrong. Alright, of course, there are risks that do not neatly fit into any of these categories. A new, more lethal COVID-19 variant would be a devastating blow. The recent floods in Pakistan, which affected 33 million people and sent the economy into a tailspin, demonstrate the impact of extreme weather events, which are expected to become more common as global temperatures rise. One potential advantage, at least for financial assets, is that investors are looking ahead. If they can spot a peak in Fed interest rates and a bottom in Chinese growth, they may be able to drive market rallies by betting on a better future, even if the present appears bleak, which it will most likely do next year.